Okay, so chapter 4 basically finishes our accounting cycle that we started in chapter 3. Today we're going to be focusing specifically on basically the generally accepted accounting principles that apply to what's called an accounting cycle, right? And that is where you need to start keeping records, and then eventually we have to close those records. And so that's going to be some of the principles are going to be talked about here. Then we're going to actually go ahead and do all of the accounting that's necessary. So we'll do the adjusting entries next week, and then we'll go ahead and do all the financial statements and the closing entries to finish our bookkeeping or accounting cycle. All right, so learning objective 1, again, we're going to be focused on a few of those generally accepted accounting principles you saw back in chapter 2. One of the most important is the periodicity assumption, right? And in the periodicity assumption, we have to divide the economic life of a business into time periods, right? And we know those time periods. The shortest time period that we look at is a month. Then we look at a quarter. But the most we look at, in other words, the most amount of time we keep records in a company is a 1-year period of time, at which we have to go through a process where we close this record and begin a new record for the next year or for the next period. Okay. So the periodicity assumption, because it looks at the assumption that we have to divide the economic life into months and quarters and years, really applies to the income statement, right? The income statement shows us the profit and loss for a month, for a quarter, and for a year. And we also, after we do the income statement, we have to do the retained earnings statement right afterwards, right? And if you notice in the titles of the income statement and the retained earnings statement, it says for the period of, for the month of, for the quarter of, or for the year ending. And so that's the period of time. That's the income statement and the retained earnings statement, basically a subject to the periodicity assumption, because they measure those periods of time. The balance sheet does not apply because the balance sheet doesn't measure a period of time. The balance sheet, as you know from doing several of them, is just a snapshot of the day. So the balance sheet's not included in this particular set of assumptions and rules for accounting. But it does apply to the income statement and the retained earnings statement because we're measuring that on a monthly basis, quarterly basis, or a yearly basis. Okay. Well, in terms of the yearly basis, companies actually have choices. They can choose to use a traditional calendar year, which means they're going to keep records starting, of their revenues and expenses and so forth, which is the income statement accounts, starting January the 1st of every year and ending their accounting year on December 31st. Okay, again, the year is the longest period of time we can keep records. Okay, and we have to separate the years because we're not just going to be in business for 1 year. We're going to be in business for, we hope, many, many years. I mean, you look at Procter and Gamble, that has made, number of different household products, cleaners and shampoos and soaps and laundry and other types of things. They've been in business for well over 100 years. They've had to keep separate records for each and every one of those years in accounting. Apple's no spring chicken either. It's been around for a good 40 years now, maybe longer. And guess what? They've had to keep records every year separate for each of those 40 years that they have been in business. So why? Because they have to keep those periods of time by the periodicity assumption. And again, the record, I can't emphasize enough, the records that are affected by this are the income statement and the retained earnings statement. And because we always start by doing an income statement, we're going to keep track of revenue from the first day of the year, if we use a calendar year, the first day of January through the 31st of December. And then we're going to stop counting revenue for that year. Okay. We're also going to count all the expenses starting January the 1st of that year to December 31st of that year. And then we're going to stop counting expenses for that year. The very next day is January 1st of a new year, and we have to start those records all over again. Okay. Which means we have to count revenue from zero. We have to count all our expenses from zero. Okay. We have to do that for dividends as well. That's the other account that's affected here, but less so important than the income statement accounts because everything starts here. But like I said, the calendar year doesn't, I mean, the government or the accountants that do these rules don't force every business to use a calendar year. It doesn't make a lot of sense, in fact, for a retail store to report their profit and loss, their revenue and expenses on December 31st of every year, because the very biggest season retail has is the Christmas shopping season. And the Christmas shopping season is literally like 3 months long. It starts somewhere it usually starts in late October, early November, and it goes all the way through after Christmas sales go through January, into the middle of January at least. Right. So it doesn't make any sense in the middle of their biggest season to force them to say, okay, December 31st, let's report what our revenue is, what our expenses are. Do we make a profit? Because their season is still going on. Their big season is still going on. So that means that one of the things, because we can divide it into an artificial time period, we can actually create our own 12-month calendar. It has to be sequential. Okay, you can't jump from January to March and forget about February. It has to be 12 consecutive months, but it doesn't have to be the calendar year. It doesn't have to be January the 1st to December 31st. It can be February 1st to the following January 31st. Again, it has to be a 12-month period to be a fiscal year. And that makes a lot more sense for retailers where Christmas shopping season goes well into January. It's much better for them to report out periodically their profit and loss on the income statement after Christmas shopping is done. And that means they're better off giving stockholders the news of their profit and loss at the end of January rather than the end of December. Right. So for a lot of retail stores, they will use a fiscal year that starts usually around February the 1st and proceeds for 12 months until the following January 31st. Again, it has to be 12 consecutive months to be the year. So thus, that's a fiscal year. It's still a 12-month accounting period, but it's used a little bit differently. And it's an option for some businesses. Like I said, it makes a lot more sense for retail than it does for other businesses. If you're a hospital, you don't necessarily need to have a different type of fiscal year other than the calendar year, because you don't really have any big months like retail does. Oh yeah, we're having a heart attack special. We usually get a ton of people in, around Thanksgiving when they stuff themselves like turkeys, and they come in. We have this big month, so we got to push. We have to have a fiscal year rather than calendar year. I mean, it just doesn't work like that. It just it's like April's diabetes month, and we have a flux, because of Easter. Chocolates and Valentine's chocolates, and and that's when it hits people, and so they're rushing to the hospital, and so that's our big season. Hospitals don't have big seasons, right? They're busy all year round, so they don't necessarily need to have a special fiscal year unless they really wanted to. They still have the option of doing it, but it wouldn't make any sense. So they can use a calendar year. But companies like retail that have really, really big seasons, and that's true in the hospitality field as well. I mean, some companies, hotels, and attractions are seasonal. So I think after the season is done and they've closed, they should be reporting out their profit and loss for the year. So they're probably going to use a fiscal year. Um, and this is true for not just corporations, but all types of businesses, including nonprofits. The college itself has a fiscal year that begins at the very end of August and goes through the following August, because we start our fall classes in August, and that's the start of a new academic year. So we like to keep records academic year by academic year. Um, I was back in the day, I was an elected public official. Yes, I actually was elected. I was on the ballot um, as a write in, but nonetheless, it worked for my little town up in Massachusetts for their finance and budget committee. And it was a town position. But the towns and cities and basically use this very same type of fiscal year, because the very, very biggest thing that they do is the public education system. K to 12 is run by your local government. So they often base the budget around that season. School gets out in June, and usually they close their accounting period June 30th. So their fiscal year is July 1st to June 30th of every year. That's how they do their accounting records. Again, it's totally up to the organization as to how they want to structure it. They can use a calendar or a fiscal year. Okay, enough on that. Well, during that year, there are several generally accepted accounting principles that apply. And this usually is very, very important to understand in terms of when do you have to recognize things in the accounting record. Well, again, the very first accounting statement that we do is the income statement. And so we have to be very, very sure that all the revenue is there and all the expenses are there before we basically close out our record for a period of time. And so one of the principles that you'll need to know is something called the revenue recognition principle, which basically says that you have to recognize revenue in the time period that it was earned, not when you got paid for it. Okay. And so as soon as you produce that service for the customer, you have to put it in your record on that day, not particularly if that day is the end of the month or the end of the year. You can't wait and put it in the journal as the next day transaction. That would be a violation of the revenue recognition principle. You have to recognize it when you did it. And that's particularly true at the end of a period. So here is the illustration with the dry cleaning, Conrad Dry Cleaner. They actually performed work. They cleaned clothes on the 30th. Now, when they clean clothes, that's revenue for them. That's service revenue. The customer's not going to come back for those clothes and pay until July. So they literally, because it's at the end of a period, in this case, the end of a month, they actually did the work on June 30th. So they have to put it in the record as of June 30th, even though they're not going to be collecting it until sometime in July. Okay. That's very, very important to understand. And this is specific for GAAP. This is specific for GAAP. This is one of the principles and the generally accepted accounting principles that we were learned about a little bit about in chapter 2. Again, the very first financial statement we do is the income statement. So not only do all the revenues have to be there in that time period that they happened, but all the expenses have to be there in the time period that they happened. And that's what the expense recognition principle is about. Again, it's part of generally accepted accounting principles. we have to make sure that the expenses are matched up in the period when the company generated that revenue. And so expenses also follow the same rule. So look at what we've done. We've had a little bit of a review of generally accepted accounting principles that are going to affect you in this chapter. The reason they start off with this is it's going to affect you in this chapter. So one, periodicity assumption, that economic life and the time periods. Again, this only affects the income statement and the retained earnings statement. But we're going to focus first on the income statement because that's the first statement that's done, that's prepared. So that's done monthly, quarterly, yearly. So the shortest period is a month, the longest period is a year. Businesses have to keep records separate year to year to year. And so that's important. When they do decide to close the record on a particular month or a particular year, they have to make sure that all the revenue that was earned in that month or in that year, be it a calendar year or a fiscal year, is recognized and put on the income statement. They have to do the exact same thing with their expenses. If the expense happened during that month or during that year, it has to be recognized and put on the income statement. Notice when we talk about revenues and expenses, it's because the income statement is the first statement that's prepared. Okay. So again, these are rules that GAAP requires corporations to follow when they are preparing, in this case, the income statement and the retained earnings statement. Soon to follow. Because we don't really deal a lot with dividends, right? I mean, it might be one entry during a period for dividends. We're always dealing with revenues and expenses. So that's why there's a lot of emphasis on making sure all the revenue that's earned in a month or in a year is in the revenue number. It's not anywhere else. Where else could it be? That's what you're going to learn next week. You need to make sure all the expenses are on the income statement. If it occurred in a particular month, that expense needs to show in that month's record. If the expense happened in a particular year, it has to show in that year's record. What expenses could be out, where else could it be? You'll learn that next week. Okay. Woo-hoo. The drama. Actually, you'll learn a little bit of it today, but you're really going to learn how to do it next week. Why is this important? Well, because there's more than one way to do accounting. Okay. Corporations have to use accrual-based accounting, which is what you're learning in this class. But there's another way, and it's often for smaller businesses. And I think this is what was referred to where Clark was saying, well, he just kept his cash receipts in these envelopes. Yes, that's the cash basis. And that's perfectly legal. It's perfectly reasonable way to do accounting, except if you're a public corporation. You can't do it. Okay. And so small businesses, sole proprietorships, partnerships, they can use the cash basis, but not corporations, particularly if they're public corporations. They have to use the accrual basis, which is what you're learning. But that's the big difference. So again, in the accrual basis, you have to recognize the revenue in the period that it was done, that month or that year. On the accrual basis, you have to recognize the expense in that month, in that year, even if you didn't pay it yet. Even if you haven't paid the expense yet, you still have to recognize it when it happened. That's not true with the cash basis, and you'll see how that's done in a moment. Okay, the cash basis is not something we teach in this particular class because it's not part, right? It's not in accordance with GAAP. It's not acceptable way of preparing statements that are for public corporations. It's not acceptable to do that. But the cash basis is used everywhere around the country particularly for smaller businesses. How does it work? Well, let's just say here's the difference between what we're doing, which is the accrual basis, and what a small business can do that's using the cash basis. Okay. So let's suppose that we have this company called Fresh Colors, which I think it's a very nice name myself. And they paint a large building in 2016. So in 2016, they have a bunch of expenses, salaries and wages, and paint costs that were 50 grand. It bills the customer $80,000 for the work that's done, but it's not going to receive payment until next year. Well, under the accrual basis, we have to recognize that the revenue was earned in 2016 because the work was done in 2016. They painted the building in 2016. The work was done. That's revenue based on the accrual basis. These expenses of $50,000 were attributed to the work that was done in 2016. So we have to recognize the expenses in 2016. Okay. That's not true for the cash basis, because the cash basis simply records it when the cash is either paid out or received. So in 2016, they did pay $50,000 of bills, of expenses. So here the 50,000 is recorded in the cash basis for 2016 because that's when the cash was paid for those expenses. But they didn't actually receive the payment until 2017, so that's when the revenue is recorded under the cash basis. When the cash is received, we put the revenue in. And that's the only difference. That's the only difference. We are learning the accrual basis. We are not learning the cash basis. Yes. So, well, actually, is the revenue list as revenue unearned? No. No, they wouldn't have to make any entry whatsoever, because when they looked at the record, they simply would say, okay, we got this check, you know, January 5th of 2017, so that's revenue for 2017. They wouldn't even have to make the recording earlier. They wouldn't have to do that.
The one in 2016, it says revenue 80, but they're not getting paid until 2017.
Right. So, but yes, that's true.
So
But
for 2016, it wouldn't be unearned.
it would not be unearned because they did the work. Unearned is when you didn't do the work, when you owe the work. So in this case, they already did the work because they already painted the building.
Oh, okay.
So that's why it's under revenue. They will set up an accounts receivable for that, because they will receive that 80,000 in 2017, clearly, but it'll be on the record as an accounts receivable, not as no revenue. So they have to literally put it in. That's different than the cash basis, as you see here, where when the cash is received, they say they earned it. When the cash is paid, they say it's an expense. Okay. Okay, so as soon as they sold, in this case, if the movie theater, the movie was starting, you know, and they sold tickets for the movie that day, it would normally be considered earned revenue that day because the movie's happening that day. If the movie's not happening for another several days or whatnot, then it's unearned. Okay, so it's very, very important to sort of understand that there are other ways in which accounting is done, but we are learning the accrual basis. Now, because we are using the accrual basis, before we actually prepare our financial statements, which of course, the income statement is the very first statement that we prepare. So if we, and you know how those are connected, right? The income statement gives you the net income. That gets put then on the retained earnings statement, which gives us our retained earnings. That then gets transferred to the balance sheet. So if you screw up basically the income statement numbers, everything else is going to be off. And in more ways than one, as you'll find out. And so it's very, very important that we make sure that all the revenue is there and all the expenses are there before we prepare the financial statements for that period of time. And so we go through a process called adjusting. The adjusting process is simply a way to double check that all the revenue has been recognized and to double check that all the expenses have been recognized before we create our or prepare our financial statements for that period of time. Okay. And so the what you're going to be learning and doing next week, specifically, this is just the intro in objective one, is you're actually going to be doing those adjusting entries. Again, an entry only happens in the journal, and of course it travels from there, as you know. So it's very important to sort of see this as a big picture, one step at a time. Once we do the adjusting entries, we are going to make sure, again, the purpose of it is to make sure all the revenue is recognized and all the expenses are recognized. So oftentimes, when we actually do the entry, at least a revenue and expense account is going to be affected. So one income statement account is going to be affected. And where is the revenue and expense coming from? It's going to be coming from either an asset or a liability account. So a balance sheet account is going to be affected. And that's what you're going to be seeing very soon. So there are 4 types we're going to be doing for learning objective 2. We're going to be looking at the adjusting entries that are called deferrals. I'll explain it here, but we're going to be doing it next week. And learning objective 3 is going to focus on the adjusting entries that are called accruals. And we'll do that. We'll do deferrals one day next week. We'll do the accruals the next day. So we can sort of see the progress here. Okay. But a deferral, basically, to defer, right, is to postpone or to wait to do something, right? And so here, deferred expenses means that you have to wait before you can say it's an expense. Well, then we start thinking, what do we have to wait for? Well, as you'll see, for example, supplies starts as an asset. When you buy supplies, it starts as an asset. And then you have to wait to use those supplies. But once you've used those supplies that period of time, you can have a supplies expense. You can expense the supplies you've used. So that's an example of a deferred expense. Sometimes it's called a prepaid expense in some books. But deferred expenses start as assets. And once we use them, we expense. Okay. And you'll see that. Deferred revenue is the unearned revenue. It starts as a liability, right? It starts as a liability. We have to wait. We have to wait until we actually perform the service to say that it's our revenue. And it's anything that people prepay for. A lot of people are prepaying for, the new iPhones, the new Xboxes, and other things that are coming out. You could prepay for a video or a book or other types of things. You certainly prepay for hotel stays, airline flights, cruises, other types of things, right? So once the company gets that money up front from the customer, that's the unearned revenue. So it's sitting on the balance sheet as a liability. And they have to wait. That's the deferral piece, right? They have to wait to then deliver the good or deliver the product to the customer. But what happens once they deliver the product? Well, then that's their revenue, right? Well, it's sitting on the balance sheet in unearned revenue, and now we have to transfer it to revenue. It should be on the income statement. So that's those are the deferrals that we're going to be looking at. There are deferred expenses, there are deferred revenues. In both cases, we have to wait before we say it's an expense and wait before we say it's actually our revenue. Notice the expenses are on the income statement, the revenues are on the income statement. So it's going to affect the income statement. It's also going to affect the balance sheet account. Okay. On the other hand, the learning objective 3 is going to focus on what we call accruals. And accruals are very similar to what we just saw with the dry cleaner, right? The dry cleaner performed the service on June the 30th to clean the clothes, although the customer's not going to come back and pay for those clothes until July, right? Well, that's what an accrued revenue is. An accrued revenue simply is you've performed the service during this month or this year, whatever the period we're looking at, but you're not going to be collecting payment on that until the next month or the next year. And so that's basically an accrued revenue. You want to say that you need to record that you earned the revenue, but you are going to receive payment for that later, which is an accounts receivable, basically. No big deal there. Accrued expenses are, again, expenses that happened in a particular month or a particular year, but you're not paying for it until the next period, the next month or the next year. So this is true for, say, your salaries and wages. Now, notice that we just turned the corner. We're in November now. So let's say the first payday in November is tomorrow, okay, which is November 5th, I believe. And for payday tomorrow, you're getting paid for your last week in October. Okay. And that makes sense because there's usually a delay, right, in how you get paid. And so all of that work that was done in October really should be part of salaries and wages expense for October, because the work happened in October, even though you're not going to pay it until the next pay period, which happens to be in November, another month. So this is an example of an accrued revenue. In this case, the salaries and wages occurred that last week in October, but you're not going to pay it until November. So at the end of October, we would have an accrued expense. We would have a salaries and wages expense that happened for October, but you're not going to pay it until November, which is the salaries and wages payable. And you'll see how that works. But that's basically what the adjusting entries are about. They're going to affect revenues and expenses for sure, because that's the first statement we're preparing. And so we have to make sure those numbers are good as it can be. And it's going to come from either an asset or a liability account. It's going to affect an asset or a liability account one way or the other. So this is the adjusting entries that we're going to be doing in the next couple of learning objectives. And so again, the adjusting process is simply a double checking process to make sure that everything we know is accurate. So at the end of October for Sierra Corporation, did they use any of these supplies? If they've used any of these supplies, it should be expensed. Did they use any of this prepaid insurance? If they've used any of that prepaid insurance, that insurance should be expensed. Certainly, we will look at equipment as well, because equipment depreciates. We will see if we've earned any of this unearned revenue. If so, it should be in revenue, right? Or our expenses are going to be different as well. So the double checking process that we're going to be doing this chapter has to get done, is a way that we make sure the data on the income statement is very, very relevant, very, very up to date, very, very accurate, and as free from error as we can make it. Okay. And so that's really the thing that you're doing here in learning objective 1. You're learning as why we have to do those processes. And it really comes down to understanding the periodicity assumption and the two principles, revenue recognition and expense recognition. If you understand all of that, you understand why we have to double check or go through an adjusting process. So the chapter 1, learning objective 1 ends with basically sort of definitions and so forth. There are concepts in the left column, there are descriptions in the right column, and you have to match. You have to match them up. So the accrual basis for accounting, right, basically indicates that they have to record the revenue when they, oh, sorry, that's not true. I was doing great. Damn. See, but even I make mistakes. Okay, get my pen back. That's a laser. Oh, I didn't know I had a laser. Whew, whew, whew. Okay, so anyway, we'll deal with that later. I'll have my Star Wars gear on after. Companies record transactions when they occur. That's really what the accrual basis of accounting is all about. Calendar year is different than a fiscal year because a calendar year is what you and I have grown to know as January 1st to December 31st. That's one option for companies to use in their accounting records. They can keep it month to month uh, and no longer than a year. So a calendar year is the longest period of time they're going to be keeping records. They can use the calendar year, they could use the fiscal year. Periodicity assumption is that we have to divide businesses into the artificial time periods. Again, we use the shortest time period is a month, the longest time period is a year. How we define the year is up to the company. And expenses have to be recognized literally when they happened, okay, which usually matches the revenue. Okay, so these are some of the concepts that are there, and that's where we're going to stop today. Questions?